equities had a wobbly start to the year, but they seem to have stabilized somewhat, and we've seen a rotation within markets. Now, the low oil price has been affecting the budgets of large oil-producing nations, and investors have been nervous about central bank policies. I'm here at Columbia Threadneedle Investments to discuss this and more with Mark Burgess. Hi Mark.
Hi Deborah.
Good to have you here again. Now, it looks like there's been a lot of activity over the last month. Let's start with the growth outlook. Can you give us an update on that?
As you say, there's been a lot happen so far this year. It feels like it's been a long year already. And we've seen a very weak start to the year from an equity market perspective as concerns kind of broadened about the outlook for global growth, China slowing down and what that meant for the global economy. What we've seen subsequent to that has been corporate profits coming through. We're quite a long way through the earnings season. Corporate profits have been largely okay, and because of that I think that has given investors a chance to regain their poise somewhat, and equity markets have rallied off the lows. Also, the economic data coming through continues to show that, albeit at a modest level, global growth is certainly moving forward, so that has given investors some increased confidence.
What events are on the horizon that may have an impact, and I'm particularly looking at Brexit and Draghi?
Yes, we now have a date for the referendum, which is June the 23rd. We've had the much vaunted David Cameron renegotiation with the EU on our terms of inclusion, and we've now got a date in the diary. So we've got something to focus on there. That does also give us, unfortunately, some months of uncertainty, which I think will impact activity more broadly. But specifically what we've seen is a pretty sharp fall in sterling, as that's been the place that global investors have expressed their uncertainty about the outlook and have taken some money off the table. The bond market's been okay, but sterling has been pretty weak.
Now, moving on to Asia, what's the latest there?
China's been endeavouring to keep the economy moving forward, and there have been some sporadic bouts of impetus to the economy, and we need to remind ourselves that trying to grow the economy is what got us into the problem in the first place, and the over-leverage and credit expansion is something that we're still trying to unwind. But nonetheless, the official numbers would suggest that the Chinese economy continues to grow at 6.5% to 7% level. The data we look at, which is sort of on the ground, would suggest the numbers are much lower than that, and we think that we've still got further to work through in the Chinese slowdown. What we're also seeing, and this is something we have to pay very close attention to, is we're seeing significant capital flight from the Chinese economy. Specifically, domestic investors are taking their money out in quite a large way of the Chinese economy. And now the Chinese have got lots of reserves to deal with this, but it's certainly placing some pressure on the Chinese financial system and has the potential to place pressure on the global financial system. So we have to watch this closely. Okay,
so keep our eyes open there. Now Mark, can you tell me more about credit markets and the default rates?
Yes, we saw specifically the high yield market in the US, because of its high energy component, started to perform quite badly in the second half of last year. Clearly the oil price fell very heavily, and many of the shale oil companies that had financed themselves through the US high yield market had their business models called into question at the current oil prices. We've started to see some of those companies default, and that's working its way through the market, and one of the reasons why the US high yield market has performed worse than the European high yield market is for that reason. We've also seen some investors express some concern about the manufacturing recession we're seeing in the US because of a slowdown in energy, and the general kind of slowdown in growth environment that we're seeing is leading to fears of an uptick in defaults. Now, what's happened in the market is in advance of those uptick in defaults, so we haven't seen those defaults come through yet, but certainly investors have become a bit concerned about that, and credit as a result has performed quite badly so far.
Okay. You've mentioned the US. What are your views on inflation?
Well, the Fed raised interest rates at the back end of last year because it wants to, A, start normalising monetary policy, but also because it was targeting the US employment rate, and US unemployment is now down to 4.9%, which on historical measures would have suggested we're at full employment. Full employment ought to suggest some wage inflation, which ought to come through more broadly as inflation in the economy more widely. We're not yet seeing that, and it's quite interesting that despite on the face of it, full employment, we're not seeing wage inflation come through. There are lots of reasons why that. There are lots of areas where we're still seeing overcapacity, and the fall in the oil price is also very deflationary. So we don't see inflation as a problem in the US, and as a result of that, don't expect interest rates to go up very much more from here very quickly.
Finally, Mark, the financial sector has been in the spotlight. What's doing well in this area?
Well, the answer to that is not very much. So far this year, with the equity market volatility that we've seen, many of last year's poorly performing sectors have actually done quite well this year. We think that that's going to be a relatively short-lived phenomena, but nonetheless many of last year's losers have been this year's winners. The bank sector would be a big exception to that, and whether it's because of a lower interest rate environment, whether it's because of that's impact on its net interest margin, whether it's because of a weakening loan growth environment, whether it's a requirement for more capital, all of these things have reduced investors' expectations for profitability, and as a result the banks have been a continued laggard after being a laggard last year. So we don't think that's going to change in a hurry, but it's been a big thing of debate in the market. Outside of banks, there are things that we can find interesting in financials, and some of the insurance companies we think still look pretty attractive, but the banks are a big component of the financial sector, and I think bank sentiment will weigh heavily on the outlook for that reason.
Well, thank you very much for your insights, Mark. And thank you for watching. We'll be back again next month.